Hello, welcome. Welcome to week 6. We're moving right through the semester. Welcome to chapter 5, accounting for inventories. In chapter 4, we studied retail operations, and we were looking at how a company does its buying of merchandise, its selling of merchandise, how it stores merchandise, how it ships merchandise. We looked at how companies offer merchandise for sale and ships it out to their customers, how they give discounts to collect payments as quickly as possible. So we looked at the full array really of the retail operation. Buy the goods, sell the goods, collect the money. Now in chapter 5 we're going to look at just one very small aspect of that retail merchandising operation. We're going to look at just how you account for the inventories themselves, just the goods that you bring in and you store and you sell, and then how you report those. So we're looking just at merchandise inventory. Now on page 268 and 269, it gives you an introduction to inventory. It gives you this lovely picture of all this colorful vegetables in Safeway, and then talks to you about what inventory means to a business. On page 270 to 278, 9 pages, the authors talk to you about accounting for an inventory. Pages 270 to 276, they're talking about a periodic inventory, the type of inventory that was in the appendix of chapter 4. And from 276 to 278, they're talking about the perpetual inventory, the kind of inventory we talked about, the method that we talked about in the first part of the chapter. Now, as we look at these ending inventories, it's important that you be introduced to some cash flow assumptions. Now, there's going to be a physical flow of these goods through an enterprise, and then there's actually going to be an assumption of how the cash flows through the enterprise. Those will be two different flows. They'll be measured differently, and even though they should perhaps correspond, they don't have to. And so a cash flow assumption is just exactly that, an assumption that management could make that doesn't have to match reality. They can assume by their own knowledge that this would be the cash flow, this would be the way the cash would flow through the business. If you don't know what an assumption is, I ask you to look it up in the dictionary, because to assume something is to suppose it on your own. And so you need to know what an assumption is. There are 4 cash flow assumptions that can be used by managers. There is specific identification. That's where you actually know which item is which item. And in chapter 4, the authors made some strong arguments that with modern technology and barcode sorting, managers can know what items are being sold when. And in fact, they made such a strong statement as to say, in today's enterprises, purchasing of more goods is driven by those specific identification information that comes in on inventories. Now, so you could use a specific identification cash flow assumption if you wanted to. FIFO, first in, first out, is another assumption that managers can use, and it says the first inventory's in or the first inventory's out. So an example of that would be milk, and milk is loaded from the back of the shelf and down into the front, and you and I pull the items we're going to purchase. So the sale that they're going to make is from the first inventory that came in, and the last inventory that came in is still in the inventory. It's the last out, so it's at the back of the inventory. So if we think about first in, first out, would be that cash flow assumption where you're pushing the older milk down towards the front for it to be purchased, and the newer milk is being loaded at the back of the shelf. Another assumption is LIFO, last in, first out, so that the last items that were purchased were the first items that were sold. Now, an example of this would be if you could think of a manufacturing concern and think of a large production facility, and could think of trains coming in and going up on ramps and then dumping the raw materials into a pile on the ground, and they dump train car loads full of this inventory there, and then a crane comes along and pulls the inventory from the top of the pile, which would have been the last train cars that were dumped would be up there, and then they put that into the production process first. So that would be last in, first out. The last items that were dumped out of the cars were in the top. The crane came along, pulled them out of the top of the pile, and put them over into the production facility first, and so they were the first ones out. That's last in, first out, affectionately known as LIFO. The fourth assumption that can be used is specific identification. Specific identifications, is weighted average. Weighted average is an average method that is taken from all the purchases that were made in the period, but the purchases are weighted by the number of units that were purchased at each price point. So you would multiply the number of units times the price point to get the cost of that purchase. You do that for every purchase, and then you'd add together all the purchases to get the total amount spent on purchases, and you would divide that by the number of units that you acquired, and that would give you an average price per unit. And you'd use that average price to value the ending inventory. So that average price allows you to protect against price changes as much as possible. So we have these four methods that are possible to use: specific identification, last in, first out, LIFO, first in, first out, FIFO, and weighted average. These do not have to match the physical flow of goods through the enterprise. And I want to tell you at this point that the reason for studying this subject in such detail, and for future managers, no matter what their discipline, if you're going to be a leader, you're going to have to make some budget decisions, for you to understand how you're being charged with merchandise inventory, is because the tax law allows you to use one method on your income tax return and a different method on your balance sheet. It's the only methods where you can use differences between the financial statements and the tax return. Every other accounting method, you have to use the same on your income tax return as you use on your balance sheet. But the Internal Revenue Code allows for companies to use the different methods between their income statement and their balance sheet. So management would make one assumption or they could make, and they do make, usually one assumption for their tax return, the one that will give them the lowest net income and the lowest tax expense, and a different one for their balance sheet. And for their balance sheet, they would choose the method that would give them the highest net income. That was what they would report to external users of financial statements. So as we go through these, there's a strong incentive for managers to understand the differences between these. Now, when you look at the effects of cash flows on income statements, That starts on page 271, and they give you an example here. And in this example, everything is the same. The beginning inventory is the same, the purchases are the same, the goods available are the same, the sales are the same, and the number of units in ending inventory is the same. Everything is the same except the value you assign to those ending units. So if you remember, you have beginning inventories plus purchases to get goods available, minus ending inventory to get your expense cost of goods sold. You subtract cost of goods sold from sales and you get gross margin. Now that's quite a, I think, I don't remember the page number, but it's quite a ways back. And so we're going to be using that formula over and over again. When we look at this first example for what is reported on the income statement for cost of goods sold and for gross margin, none of the numbers are the same between FIFO, LIFO, and weighted average. So management has a great deal of discretion there. If they were facing rising prices, they would want to take LIFO so that they could match the most recent high prices against sales and have good matching. If they thought the prices were falling, they would want to take FIFO and match the oldest costs against sales to get the lowest net income. And if they were facing oscillating prices changing and going up and down, they would want to use weighted average and have and try to mitigate those price changes as much as possible. So as we look at those effects on an income statement, we can begin to see how you would get a different profit and a different tax expense with each of these assumptions. Then as we look at the effects on the balance sheet at the bottom of page 271, we notice that the ending inventory is different, and so that asset value is going to be different for each one of these assumptions. When you look at page 272 and you look at the check yourself example, you begin to see again that while sales are constant and cost of goods sold, gross margin, and ending inventory are all different based on which assumption, which cash flow assumption you choose. Now, as you want to think about these, you want to begin to remember that ending inventory is an asset, so it's going to be in the asset part of the balance sheet. Profit comes out of the income statement and goes into retained earnings. So those are two significant accounts that will be different in the balance sheet depending upon which of these cost flow assumptions that you choose. And the income statement will have a different net income and from operations, a different tax obligation, and a different net income after tax, depending upon which assumption that you make. Now, in all of these cases, what we're trying to do is to value the ending inventory and allocate goods available for sale between cost of goods sold and ending inventory. So starting at the bottom of page 272, these are all the periodic inventory calculations that we would be making. You saw periodic inventory in the appendix to chapter 4. You might want to go back and read about that as a refresher for giving the context to these calculations. These are the calculations starting on page 272 that you're going to have to do in your Excel lesson. So you're going to be doing all of these calculations on Excel using your Excel spreadsheet, and you're going to be comparing them just like they're doing, just like the authors are doing in the textbook. So at the FIFO, first in, first out, inventory cost flow assumption, the top of page 273, you have a beginning inventory, you have two purchases, you have sales. And that's what your problem's going to give you for your Excel problem. And then you're going to have to calculate the cost of goods available, the cost of goods sold, and the ending inventory, just like is explained to you on the top of page 273, using those formulas, and then distributing them using the cost of goods sold formula. So look those over carefully, read about those, mark those equations so you can get back at them, and then notice how the calculations are done. Now, with LIFO, it's the last in, first out, so it's the opposite. It's reverse of FIFO. So when you look at the bottom of page 273, they present you the inventories in reverse order. They show you the August sale, they show you the March sale, and then they tell you the number of units sold. And so you then begin to have to work with, and of course you'd have the same beginning inventory. So now you have to make these calculations, but it's using the last in, which would be August, the next in, which would be March, and the last ones that you would sell at all would be your beginning inventory. So these calculations then are done in reverse. Turning the page, then you see the weighted average. And as I told you earlier, this calculation at the top of page 274 is going to have you taking an average, have you weight every purchase at that price point for the total cost of that purchase, add together all the purchases, get the total purchases and divide them by the total units acquired to get an average cost per unit. And then you'll value the units in ending inventory using that average cost per unit. So that's at the top of page 274. They tell you about the impact of taxes, just as I did on the bottom of page 274, about multiplying times the tax expense percentage, income from operations, and then making a provision for an income using income tax expense and income tax payable to cover that tax obligation, or getting the tax benefit if you have a loss and have an income tax receivable. So at the top of page 275, they show you what an income statement would look like with all three, what a balance sheet would look like with all three cash flow methods, and then what a statement of cash flows would look like for all three methods. And that's the ending results that you're going to have on your Excel problem. So you want to mark this page 275 and make sure that you can look at these. You'll have to do these tax provisions and disclosures that are given to you here at the bottom of page 275. They give you a check figure there at the top of page 276 so that you can look through, say, how would I check myself? And those proofs are part of the solution also in the Excel lesson this week. So you want to be sure that you know where to go back and look at those examples and pull the numbers and get the results and the check figures. Now, on the top of page 276, 277, and 278, they talk to you then about what about when you have intermittent sales. And so instead of this constant flow of sales that we were talking about, now we're back to a perpetual inventory. So starting on page 276, they're showing you how to calculate the ending inventory for perpetual inventory, where you're calculating it with every sale. So at the top of page 277, they show you how to use FIFO, LIFO, and weighted average every time you make a sale, and then calculate that ending inventory. So again, you want to look at that detail, and this would be the way the first half of chapter 4 was presented to you for perpetual inventories. And at the middle of the bottom of page 278, that leads us to the ending of this presentation of calculating ending inventories. This is a major lesson, all of these calculations from page 270 to 278. You want to make sure you have those marked and you have those identified and that you want to practice with those. You can look at the separation of the goods available for sale between cost of goods sold and gross margin. And then you'll want to be sure that you remember you'll get an ending inventory quantity, a unit count. Then you'll multiply that unit count by the ending inventory values. And then that will determine, that ending inventory value will be used to determine cost of goods sold, because you'll subtract that ending inventory value from goods available and get cost of goods sold and then ending inventory. Now, with that presentation, I want to then turn your attention to the bottom of page 278 and another lesson that comes up in this chapter. And it's a major lesson, and it's one that you should understand, and it's called lower of cost or market. Generally accepted accounting principles require every inventory calculation that's done to be examined for lower of cost or market. And the concept here is that due to conservatism, if an inventory is considered to have a lower replacement cost than what you paid for it, and that is going to be a continued loss, it's a permanent loss, then that loss, I'm sorry, a former student, it's homecoming weekend, and a former student with two of his children just came by my window, and I held his kids up for me to see. So that was what that little break was about. Lower of cost or market, if that's considered to be a permanent loss, then you have to write that inventory down permanently to the lower of the replacement cost. So you examine every inventory, you look at its cost, and you look at its current market value, what it could sell for now, the replacement market value. And if it's a permanent loss, then you write it down, every single inventory. So you can look at lower of cost or market. You can begin to see how the calculation is done on page 279, and the debit to cost of goods sold to increase that expense, and the credit to inventory to write down that expense is the journal entry on page 280. So you would write down permanently the inventory by the amount of that lower replacement cost in the inventory. The next major topic is avoiding fraud, and we have said to you that inventory is a major asset, a huge asset size on the inventory, and it could be quite vulnerable to managers who might want to overstate inventory or understate inventory to manipulate cost of goods sold and manipulate the amounts that are on the balance sheets and income statements and tax return. So as you read about avoiding fraud, you want to think about an unscrupulous manager could artificially change the numbers of these inventories, manipulating the values and producing financial statements that were inaccurate and misleading. So they would overstate or understate inventory one way or another to get these results. The argument here to you as a manager is to say, I would not want to support that in any way in my enterprise. I would want to understand this, and if I thought one of my managers that was reporting to me was misstating inventories, I would want to investigate that. I would want to look into it, and I would not want to be signing off or tolerating any fraudulent statements. So you want to read about that and have an appreciation for it. The distortion of under or overstated inventory can have a significant effect on cost of goods sold, cost of ending inventory, profits, and taxes. Now, the next topic is on page 282, and that topic is a more common topic, hopefully, because it could happen at any time. Now, what we're talking about here is estimating the ending inventory and using the gross margin method to estimate the ending inventory. Now, the inventory could be lost at any time. You could have a fire, you could have a flood, you could be hit by a tornado, you could have an earthquake that knocked all the goods off of the shelves and broke most everything, and you just had to sweep it out to get rid of it. So due to this type of an unexpected loss, a crisis management loss, accountants might have to come in and estimate the ending inventory. Now, using the gross margin method, which is what we're talking about in this chapter, there are other methods, but the one we're using right here is the gross margin method. You would look at an inventory that was destroyed, and you would go back and say, in this example they give you in the book, they say for 5 years, the gross margin percentage had been 25% of sales. 75% of sales had been in cost of goods sold, 25% had been in gross margin. Remember, those numbers are complementary. They add back to make 100. They complement one another. So if 25% of the ending inventory, 25% of sales was in the gross margin, then I could make the assumption that this period would follow that same pattern that's been established over the last 5 years. So if I had to estimate the ending inventory, I would take my sales that I'd made. I'd have records of my sales stored on my computers and safeguarded, my backup in places. And so I would take my sales and I would multiply it by the gross margin, and that would give me the percentage, and that would give me an estimate of what my gross margin would be right now. And since that estimate would be the gross margin, I could subtract the gross margin dollars from the sales dollars and get the cost of goods sold dollars. Once I knew the cost of goods sold dollars, I could then subtract those from the goods available, and I would know what the ending inventory was estimated to be. So I could get the goods available, beginning inventory plus purchases, from my accounting records. I could get sales from my accounting records. And so I could use sales times my gross margin percentage to tell me how much my gross margin would be in dollars, and I could subtract those dollars from my sales, and the remaining dollars would be my cost of goods sold. Now, once I know the 25%, I can obviously also multiply sales times the 75%, but that can also be the check figure, which is normally how it's done. And so then the cost of goods sold subtracted from the goods available would tell me the ending inventory number. And that information is given to you on page 282. It goes down here and goes through to page 283. Now at page 283, we then have the financial analyst information. And when we look at the financial analyst information, we begin there to talk about the ratios and how people outside the enterprise might use our financial statements to make decisions about our company. They might be investors buying our stocks, investors buying our bonds. They may be lenders wanting to loan us money. So there's a number of people outside these stakeholders. Suppliers might giving us lines of credit might want to look at our financial statement, and they might want to begin to use these ratios that we're talking about at the end of every chapter to see how we're managing our enterprise. Now, the ratio we're talking about this week is inventory turnover ratio. And the inventory turnover ratio is a ratio to tell us how many days the inventory sits on our shelves before it's sold. And so what is the interval of our average sales? So it's a two-step process, two-step formula. First, you take cost of goods sold and divide it by inventory to get a turnover rate. And then you take 365, which is the number of days in a year, and multiply that by the turnover rate, and you get a number of days in inventory. So you can see that if you have foodstuffs you'd expect that are perishable, you'd expect that turnover rate to be much faster. And if you had something that was very expensive and didn't sell very often, like furniture or cars or jewelry, you would expect that turnover rate to be much slower, not more days in inventory. But that becomes a very important number that people look at to see how quickly you're turning over your inventory, how demand that customers are making to get to buy your products. They give you some real world experiences in the rest of the page 284 and then page 285, some real world experiences, and that brings us to the end of the chapter, the looking back and then the looking forward at the next chapter. So I want you to see that this is actually there's more detailed calculations in this chapter, but it has far less information in it. It's building on the accounts that you know from chapter 4 and bringing those forward and requiring you to use those journal entries, but to use those journal entries with calculations now that you're making yourself. So you want to realize that you're now, instead of being given the numbers, you're being asked to calculate the numbers for your cost of goods sold transactions. Well, that brings me to the end of my overview for this chapter. I welcome you again to week 6, welcome you to chapter 5, and invite you to study this chapter for calculations, and then invite you to send me an email or ask questions in class or come by my office, whatever suits your schedule, to ask me any questions about anything in chapter 6. I'm looking forward to working with you this week on accounting for inventories.